Happy Monday, everybody. Today is June 29th, 2026, and this is your Monday Market Update. Now, I hope everyone had a great weekend. As we wrap up the first half of 2026, I think this past week gave us an important reminder about markets. Sometimes the headlines make things look much worse than they really are. If you glanced at financial news last week, you probably saw stories about the NASDAQ falling for 5 straight days, semiconductor stocks getting hit hard, and concerns that the AI trade might finally be losing steam. But when you dig beneath the surface, a very different picture emerges. The Dow actually finished the week higher. Healthcare, financials, utilities, industrials, consumer staples, and many value-oriented stocks all held up remarkably well. This wasn't a broad market sell-off. Instead, it was a rotation within the market as investors became more selective about where they wanted to invest. In many ways, this was a healthy development. Over the past couple of years, almost anything connected to artificial intelligence seemed to move higher. Now, investors are beginning to separate companies simply talking about AI from companies actually generating meaningful earnings and revenues because of it. That's a sign of a maturing market, not necessarily a weakening market. At the same time, investors continued watching developments in the Middle East, particularly negotiations involving Iran and the status of shipping through the Straits of Hormuz. Oil prices remained one of the biggest drivers of market sentiment throughout the week, and as energy prices generally moved lower, concerns about inflation eased as well. The Federal Reserve also remained front and center. Since Chair Kevin Warsh's comments following last week's Fed meeting, investors have become increasingly focused on every piece of economic data for clues about whether an interest rate increase could still be on the table later this year. So let's take a look at how the week unfolded. To start the week, markets opened cautiously optimistic after reports over the weekend suggested additional progress towards a long-term agreement between the United States and Iran. The possibility of a more stable Middle East immediately helped oil prices move lower, easing one of Wall Street's biggest concerns over the past several months. Lower oil prices raise hopes that inflation could continue cooling, and that's generally positive for both consumers and businesses. Initially, stocks responded well, but as the morning progressed, the tone changed. Technology shares suddenly came under pressure, particularly many of the companies that have led the market higher throughout this year. Interestingly, there wasn't one major headline responsible for the selling. Instead, institutional investors pointed to several developments happening all at the same time. Currency markets became more volatile, particularly involving the Japanese yen, which likely forced some hedge funds to unwind popular trades that had favored high-growth technology companies. At the same time, investors continued questioning the enormous amount of money being spent to build artificial intelligence infrastructure around the world. Now, it's important to understand that investors weren't suddenly deciding artificial intelligence was a bad investment. Far from it. Rather, they were beginning to ask a different question. Instead of simply rewarding companies announcing massive AI spending plans, investors wanted to know when those investments would begin to produce meaningful profits. That distinction would become one of the biggest themes throughout the rest of the week. Despite the weakness in technology, many other sectors actually held up well. Financials, industrials, and several defensive areas of the markets attracted buying as investors rotated into companies with more attractive valuations and dependable earnings. But by the closing bell, the Dow finished up about 0.25%, S&P finished down about 0.25%, and the NASDAQ declined about 1.25%. Tuesday, the technology sell-offs accelerated. Overnight, semiconductor stocks across Asia experienced one of the sharpest declines of the year, particularly in South Korea, where memory chip manufacturers came under heavy selling pressure. That weakness quickly spread to the United States before the opening bell. The NASDAQ opened sharply lower, with many of this year's biggest winners once again leading the decliners. At first glance, it looked like investors were abandoning the AI trade altogether, but once again, the reality was much more nuanced. Institutional research suggested investors weren't questioning the future of artificial intelligence. Instead, they were beginning to question the economics behind building it. Think about what's required to construct these massive AI data centers. Companies need advanced semiconductors. They need specialized memory chips. They need enormous amounts of electricity. They need expensive networking equipment. They need highly skilled engineers commanding record salaries. They need billions of dollars of capital to keep expanding. Those costs have been rising dramatically. As a result, investors began asking whether current stock prices already reflect years of profit that have yet to materialize. One of the encouraging developments, however, was that the broader market remained surprisingly resilient. Healthcare stocks moved higher. Consumer stocks gained ground. Utilities performed well. Real estate also advanced. In fact, 7 of the 11 major sectors finished higher, showing that money wasn't leaving the stock market altogether. It was simply moving in different areas. That tells us this wasn't widespread panic. It was a rotation. Investors were taking some profits in the highest flying technology names while putting money to work in sectors they believed offered better value. By the closing bell, the Dow finished down just 0.1%. S&P declined about 1.5%, and the NASDAQ fell a little more than 2%. Moving into Wednesday, the pace of selling did slow considerably as investors shifted their attention to what many believed would be the week's most important corporate events, Micron Technology's earnings report after the closing bell. Rather than aggressively buying technology shares after the previous 2 days of selling, investors largely chose to wait and see whether one of the biggest beneficiaries of artificial intelligence could justify the enormous expectations surrounding the industry. Throughout the day, there were several encouraging developments outside of technology. Oil prices continued falling as optimism surrounding Middle East negotiations improved. Treasury yields drifted lower. Housing data suggested portion of the economy were cooling modestly without signaling recession. All of that helped support many sectors outside of technology. Still, investors remain cautious ahead of Micron's reports. By Wednesday's closing bell, the Dow Jones Industrial Average finished up about 1/3 of 1%. S&P slipped 1/10 of 1%, and the Nasdaq finished down just under 0.5%. Then came Wednesday evening, and we got one of the week's biggest stories. Micron reported earnings that significantly exceeded Wall Street's expectations. Revenue more than quadrupled from a year ago. Earnings easily beat forecast. Management projected another substantial increase in revenue for the coming quarter as demand for high-capacity memory chips used in artificial intelligence applications continued to surge. Why was this important? Because after 2 days of investors questioning whether all of this AI spending would eventually pay off, Micron showed that at least for some companies, those investors are already translating into real sales, real earnings, and real cash flow. In other words, the AI story didn't disappear. It simply became more selective. Investors are no longer rewarding every company that mentions artificial intelligence. Instead, they're rewarding companies that can demonstrate measurable financial results. I actually think this is healthy. It's a healthy progression for the market. Moving into Thursday, Micron's earnings initially sparked a strong rally across the technology sector. Shares of Micron jumped nearly 20% shortly after the opening, and helped lift semiconductor stocks and much of the broader market earlier in the session. We also received another round of important economic data. Durable goods orders were weaker on the surface, but when economists looked beneath the headline numbers, business investment remained surprisingly healthy. First quarter GDP was revised upward to an annualized 2.1%, confirming that the economy entered the second quarter with more momentum than previously believed. At the same time, core PCE, the Federal Reserve's preferred measure of inflation, increased to 3.4 year over year. We talked about that last week. While that was in line with expectations, it reinforced the message that inflation continues to run above the Fed's long-term target. So investors found themselves balancing two competing stories. On one hand, stronger economic growth is generally good for corporate earnings. On the other hand, stronger growth and sticky inflation could make it more difficult for the Federal Reserve to begin lowering interest rates. Geopolitics also returned to spotlight. Reports surfaced that Iran could impose significant fees on ships passing through the straits, contradicting earlier expectations that shipping would return to normal without additional costs. Later in the day, reports of a cargo ship being struck by a drone caused oil prices to rebound, adding another layer of uncertainty for investors. By the closing bell, much of the morning's enthusiasm had faded. The Dow still managed to finish up about 0.1%. S&P was essentially unchanged, slipping just 0.01%, and the Nasdaq declined just under 0.5%. Friday wrapped up the week with another reminder that markets rarely move in a straight line. Despite Micron's outstanding report, semiconductor stocks around the world came under renewed pressure overnight as investors continued reassessing valuations across the technology sector. South Korea's stock market experienced another sharp decline, driven largely by weakness in memory chip manufacturers, and that selling pressure spilled into U.S. markets before the opening bell. Yet once again, if you looked beneath the headlines, the broader market was far healthier than it appeared. Money continued flowing into healthcare, utilities attracted buyers, consumer staples held up well, industrial companies continued outperforming, and financial stocks remained resilient. In other words, investors weren't abandoning equities. They were simply broadening where they wanted to own them. By the end of the session, the Dow slipped just 0.1%, S&P edged lower by just 0.05%, again, small numbers, and the Nasdaq declined about 0.25%. So when we step back and look at the entire week, I actually think there are several encouraging takeaways. Yes, the headline focused on the technology pullback. Yes, the Nasdaq experienced its weakest week in several months, but the broader market demonstrated impressive resilience. For the week, the Dow was a little bit up over 0.5%, making it the third consecutive weekly gain. The S&P declined 2%, while the Nasdaq fell over 4.5% because of a sharp rotation out of semiconductor and AI-related names. Perhaps the most encouraging development was the broadening of the market leadership. Healthcare, utilities, consumer staples, industrials, financials, and real estate all held up well despite the weakness in large-cap technology. In fact, the equal-weight S&P 500 reached new highs during the week, suggesting that many companies outside the mega-cap technology names continued performing well. To me, that's what healthy bull markets often look like. Leadership evolves, investors take profits in areas that have become expensive, capital gets redeployed into into companies with attractive valuations, strong earnings, and dependable cash flow. That's exactly the type of rotation we saw this past week. Now, looking ahead, this will be a shortened trading week because of the 4th of July holiday, but don't let that fool you. There are several reports that could move markets. On Tuesday, we'll receive the latest consumer confidence report along with the JOLTS job openings data, giving investors another look at both consumer and labor market. Wednesday brings the ADP employment report, the ISM manufacturing index, and the comments from the Federal Reserve Kevin Warsh at a European Central Bank conference in Portugal. Investors are going to be listening closely for any additional clues about the Fed's thinking on inflation and interest rates. Then on Thursday comes what is likely to be the week's biggest event, the June employment report. Expectations are for approximately 130,000 new jobs to have been created during June, with the unemployment rate holding steady at 4.3%. As always, investors will be paying close attention not only to job growth, but also to wage inflation, since strong wage growth could reinforce the Federal Reserve's focus on keeping interest rates higher for longer. We'll also hear from several well-known companies this week: Nike, Constellation Brands, General Mills. Their results should provide additional insights into consumer spending as we head into the second half of the year. Finally, remember that markets will close early on Thursday ahead of the Independence Day holiday. Both the stock and bond markets will be closed on Friday. As we begin the second half of 2026, I think this week's biggest lesson is that healthy markets don't need every stock moving higher at once. Rotations are normal, they're healthy, and often they extend bull markets by broadening participation across more sectors of the economy. The economy continues to grow, corporate earnings remain solid, business continues investing, and while investors are becoming more selective, they haven't stopped investing. They simply are demanding stronger fundamentals. As always, thanks for spending a few minutes with me today. I hope you have a great week. Enjoy the upcoming 4th of July holiday with family and friends, and I'll see you right back here next Monday. You can check in on the Friday video. This week is scheduled for Thursday. Have a great weekend.